Okay, so let's go back to this example. Because step 1, tax basis, step 2, fair market value balance sheet, step 3, inherent gain. That's what we have up there. And this is something that you need to know for built-in gains, because that up there, the slide on the screen shows the built-in gain after we've done it. There's a couple rules that you need to know about built-in gain and the application of built-in gain. 1, measure built-in gain and built-in loss by asset.
These are rules.
Yeah. These are rules. So what we've done is we've measured our built-in gain or a built-in loss by asset, and there's 2 assets that have a built-in gain. Two, measure built-in gain / built-in loss globally / entity-wide. Because what we've done is we said the capital asset has 150, a built-in gain. The goodwill has a built-in gain of 500 or 550. That's step 1. Step 2 is, well, we got 700,000 globally. That's step 2. Because the point of the asset by asset is, disposition. You look at the built-in gain at conversion. You measure that against global. So what that means is, if, going back to the previous slide, let's pretend for a second that instead of having 150 of capital asset, that we had 450 of loss built into the capital asset. I know that's impossible, but whatever. The asset by asset says I have a built-in loss in the capital asset of 400. I have a built-in gain in goodwill of 550. So I've measured it on an asset by asset. Then I measure the overall entity-wide, which if I have 450 loss and 550 gain, that's 100,000 that would be available that would have been subject to double tax if I sold my assets. So when I go to dispose of my goodwill, well, my built-in gain was 550, all right? And I sell it and the 550 is generated, populate that. But now that 550 is more than what was available for the overall organism. So let's change the facts a little bit. Let's say that we have the goodwill that has 550 of gain, the capital asset of 150. No, let's do this. It'll be easier if I do it this way. Goodwill, built-in gain, 550. Land, built-in loss of 100. Let's make that 200. And building built-in gain of $200. Net $550 overall. So we sell the building for $200, or generate the $200. What was the built-in gain at date of transition? Was $200. Was the global amount of $550 more or less than that amount? It's more. So we now have to report double tax or tax on that amount, and we'll talk about that in a second. Okay, so 550 is what we had globally at conversion. And we have to measure this for a period of 5 years. Well, we sold the building, and we had to say, well, we recognized 200. So we now get to deplete that built-in gain that existed by the 200 we had to recognize. So now, if we sell the goodwill within the next 5 years at 550, even though 550 existed at the date of conversion, we've already reported 200 by virtue of already selling the building. So the only amount that you're ever going to report, the ceiling, is the amount that existed at the date of conversion. So it's an asset-by-asset calculation, and it's a global calculation. So the next rule is if you have a recognized built-in gain, taxable to the extent of current year income. So what that means is we said that we had 550 of global, we had 200 that we recognized, and it got us down to 350 remaining. Is that what we said? So now, under 3, we have 200 that we have to contend with because we have now recognized that. The taxable income, I'm going to pretend of this S Corp in year 1, or year of disposition, is negative 100. And we recognized this in year 1. So what Rule 3 says is, look, you quantified it on asset by asset, you sold an asset, you compared it to the overall global entity amount, you now know that you have to recognize it because it's less than the overall global amount, so you have to recognize it. The third rule says, well, wait a minute, if you're having a shitty year and you don't have enough, you didn't report any income, we're not going to make you pay any tax. So if you have a loss, 0 or something in the loss, you don't have to pay tax on that. But it's recognized, and it has to be carried forward to a future year. So if we get to year 2, and we have $50 of income, well, year 2, we're able to recognize 50 with 150 carried forward. So now we have to pay tax, an entity level tax on that 50. And then we get to year 3, and we have 300 of income. Well, now we're able to recognize all of it. So what's that mean when we have to recognize and pay tax on that? The entity, and I'll use a 30% tax rate, has to pay 30% is $15. Okay? So the entity now has to pay $15 to the IRS. That $15 that gets paid to the IRS Remember that tax calc. That $15 that we have to pay due to built-in gains to the IRS, the $50 that we had to recognize because that's the total amount of income that was available, generates $15 of tax. That $15 of tax that we have to pay the IRS is a deduction that occurs at the entity level. It takes my $50 of income down to $35. So in this case, it'd be a $45 deduction because I reported all $150 in the next year, and I would have $255 of income. So the built-in gains tax that is paid at the entity level is a deduction against the entity level income. So again, one is measure it by asset by asset. Two, measure it globally, because if the global amount is less than all the on asset by asset due to built-in losses, then you got a cap. Three is when you actually recognize it, you have to measure how much income do you have, and is that, can you recognize, do you have a limitation in that year due to it being in a loss? And if you have a loss, you have to carry it forward to a future year. So now I've recognized 200 and I have 350 that's carried forward to a future year that I have to recognize.
So if you have losses for every 5 years, then it just goes away.
So your question is, if I recognize I sell that asset in year one, and I got 200, and instead of having 50 and 300 in year 2, 3, I have 100 loss, 100 loss, 100 loss, 100 loss, 100 loss for the next 5 years. Do I escape built-in gains? The answer to that's no. Once it's recognized, you're stuck with it. And let me give you a really good example of that. Jameson, were you the one asking about installment sales? Okay. And our installment sale example, as I recall, was 9 million, 4.5, 4.5, 3 million, 3 million, 3 million, right? And we have a gross profit percentage that's applied at 50%, so 1.5, 1.5, 1.5, right? That was our example for our installment sale. And the question that Sam just asked is that, hey, if I recognize that and I get through the 5-year recognition period, do I get away from it? That's your question.
Yeah.
The answer to that is no. And what's even worse is, let's say that this asset had 4.5 million of built-in gains associated with it that we quantified in step 1, and the overall entity value was 10 million, so the 4.5 is less than the 10. Therefore, when we do the installment sale, all of it's subject to built-in gains. If we sold it all at once, we pay built-in gains on it. So if we now have this installment sale that we sell on the 4th year, 363rd day, we're still in the 5-year period, right? So since I sold it in the 5-year period, even though the collection and the income's occurring outside the recognition period, it's still subject to built-in gains because I sold it within the 5-year window. And have I seen that? Yes, I have. So if you recognize it in that 5-year period, when I say recognize, we sold it. The 350, if we get outside the recognition period, is no longer subject to built-in gains. So let's talk about, I'm going to change this a little bit because this needs to be more refined than what we're doing. We're playing with concepts. because this is important. Or at least I think it's important. Okay, I think I had I had goodwill of 550. Is that what it was? Built-in gains.
Yeah.
And I had land. Was it land?
Yeah, built-in loss of 200,
200.
and then building 200.
Okay. Actually, that works out nicely. Accidentally. So I have an overall entity. Oops. Built-in gain of 550. Correct? So if I sell the building, I have a recognized built-in gain of 200. Well, I accidentally did this. I didn't do it on purpose. What generally is going to go with the building?
The land.
Land. So part of that procedure that I wrote down is you have to take all the built-in gains and losses that were recognized in that given year and sum them up. So we have recognized gain on building of 200. We have recognized loss on land, 200, 0. So if you have, and where this planning comes into play, which I have done this before, and you see this with doctor groups, is the doctor group will have an AR of 10,000. And doctor groups, are they generally going to be on accrual basis, Thomas, or cash basis?
Like doctors?
Yeah.
Um,
Cash, that's right.
Cash.
Okay, so if they're on cash basis, the basis in that AR is 0, correct? But the fair value is 10,000. So part of the built-in gain process is what's tax basis? 0. What's fair value? 10. And if we sold that asset at date of conversion, it would be subject to double tax. Therefore, if we transact on that item within the next 5 years, it's going to be subject to built-in gains tax. And I'm going to take this one step further to say tax basis, fair market value, inherent gain, because this is the process that we do. And AR is 0, 10,000, 10,000. We have goodwill with tax basis is 0. And we're going to say this is 100,000. 100,000. And we have liabilities, 0, 0, 0. Equity, 0. 110,000. 110,000. So I've gone through the process. I've measured all the assets on an asset-by-asset basis. My AR has got an inherent gain of 10,000. My goodwill has an inherent gain of 100,000. And my overall entity-wide gain is 110,000. Okay, so we've kind of done that procedure on some level. So, Thomas, stupid question. Is that AR going to be collected 5 years from now?
Unlikely.
When's it going to be collected?
Hopefully within the next year.
Within the next year. So it's almost unavoidable to get away from built-in gains associated with that cash basis AR. Well, fortunately, this doctor went to Lane and Associates. And Lane and Associates says, well, wait a minute. We have this rule over here that says you have to net your recognized built-in gains and your recognized built-in losses in the same year that they're both recognized. And Lane looks at this balance sheet and says, well, Doc, you don't have any built-in losses. But I'm smart. I know what to do. We're going to have you, Doc, we're going to have you book in the final year of your C Corp return, because you own 100% of this. And do you think I've done this before, Lane? Yes. The Doc owns 100%. We're going to book a bonus payable of $10K in that final C return. So now my liabilities because when I do that final C return, if you have more than a 50% owner of a C Corp and there's a bonus that's booked and payable to that 50% or more owner, or 51% or more, well, I'm going to say my book income is, my book is 90, but I can't take the bonus, so my M1 is 10, and my taxable is 100. So now I was unable to take that liability, that accrual for the bonus in the final C return. So now I have this liability that has not been deducted. That liability that's not been deducted is a built-in loss. And this is a built-in gain. So now we get to the first year of S, and we have 10,000 of AR that was collected, which is subject to built-in gains because it existed as of the date we converted. But we pay out the $10,000 bonus to the Doc, which that $10,000 bonus is a built-in loss. 0 built-in gains. So now I've manufactured a way to avoid built-in gains in the first year of operation, and I've been able to get this doctor practice into S Corp status. So the other asset that we have is goodwill of $100,000. If we sell that goodwill, Natalie, in the first 5 years, in the first 5 years, do we pay you built-in gains tax on it?
No.
Yes. Yes, we do. So let's go back to the whole premise of built-in gains. The premise of built-in gains is we're not going to allow you to convert into S status to avoid double taxation. In the pursuit of not allowing you to convert into S status to avoid built-in gains, we're going to require you to go through this tax basis, fair market value, and inherent gain to quantify the amount that would have been subject to built-in gains if you sold at the date of conversion. So if we sold at date of conversion, $100,000 would have been subject to double tax. So if we get and we play Lane's magic trick of booking this bonus payable and avoid built-in gains on the collection of the AR, life's good. So what happens if somebody knocks on the door in the middle of year 4? We're within our 5-year recognition period. And they say, we will give you $10 million for your practice. Fine, you're overpaying. So they say, we'll give you $10 million. Goodwill still has a 0 basis. There's a $10 million gain in year 4. How much is subject to built-in gains tax?
100.
What was that, Emma?
100.
Why?
Because that's the inherent gain that we calculated.
That's right. The only amount that's subject to built-in gains tax is the amount of gain that existed at the date of conversion. the appreciation that's occurred from the 100,000 up to 10 million occurred while we were in S corp. And since that appreciation occurred while we were in S corp, that means it never would have been subject to double tax. So going back to that earlier example where I said, own your mistakes, literally own your mistakes, and that LIFO problem that I talked about, the reason we converted was goodwill was worth 100,000. This thing's going to go to the moon. And and the probability somebody's going to want to buy your stock because and avoid or forego getting the step up of basis and assets because I buy your stock, is closer to 0 than 100%. So if we convert today, get through the 5-year period, the $100,000 goodwill that appreciates to 10 million is not going to be subject to double tax. And the sale of stock generally is going to be taxed to capital gains. The sale of goodwill in an S corp is going to generally be taxed to as capital gains. So you're in the same spot. But whoops, I forgot the LIFO. And that truly was what we were motivated. That's why we were doing it. We were trying to capture the appreciation over 100,000 and not have it be subject to double tax if somebody knocks on the door. By the way, it was $90,000 a year that the guy had to pay. It was like, whoops, sorry. It wasn't a fun conversation. So, how much was subject to built-in gains, Emma?
100.
100. Why?
Because that's the ceiling that you can take the gain on.
That's the ceiling that was determined when you measured on an asset-by-asset basis. That's built-in gains, kind of. And we see built-in gains. Who said they had to do built-in gain calc? I mean, how many have you done?
I have one waiting.
3.
You do?
With one that all their stocks were in an investment account, so you have to go through the 1099 and
Determine the fair value of each stock?
yeah,
Yeah, that would suck.
it does suck.
That's that limitation. Don't care. Don't care. LIFO recapture, we talked a little bit about it earlier. And what I really want you to know about LIFO recapture is that if you're converting a C corporation that has LIFO, call me. I mean,
What if you're retired?
do what?
What if you're retired?
I'll still take the call unless this place has really pissed me off.
When are you going to retire? Actually,
Let's see, somewhere between probably 5 and 7 years, in that range. But I suspect, unless we actually have a sit-in where everybody walks out, they wouldn't mind me to come back and continue to do this and maybe some transactional work, I suspect. But if they don't, okay. I'm okay with that.
Where are you gonna move when you retire?
Sit on my fat ass is what I'm going to do.
No, he said, where are you gonna move?
Where am I going to move?
Yeah.
Florida, where we should be right now.
No, no.
Megan.
Actually, in my mind, I want to travel. Let's say I go at 60, I'd love to just travel for 10 years to the extent that it's almost obnoxious. And then once I get through that, I suspect, I'm done traveling. And at that point, do I want a place in Florida or do I want a place in Arizona or I'm happy I got grandkids here, God only knows. But I don't want to buy a place until I exhaust myself on wherever it is I want to go and go see whatever it is I want to see. Because why would I have a place? And I actually, when I was your age, I thought RV sounds like a great idea. At this age, I'm thinking, RV sounds like a terrible idea. Okay. I think I should care more about it. I think you guys have rubbed off on me. Because my give a shit level about wanting to talk about this right now, I think, is probably swear to God, less than you want to hear it. Because you guys have worn me out.
Goal accomplished.
No, we're going to hold strong. And again, just out of sheer stubbornness, if you push back too much, I'm sure I can talk my sister into another card. See?
Nope.
Okay.
You're gonna have to pick a side.
Do what? Do what?
You're
What'd you
gonna have
say?
to pick a side.
Like 1 through 10.
Strength of numbers.
Okay, so passive income tax. Now, I said this earlier. It applies to a C Corp that is converted to S status. The C Corp, or the C Corp has E and P at data conversion. The S Corp sells most assets. Remaining assets create passive income. Okay, so let's talk about the word passive for a second.
What's the second point say on that?
I don't know. C Corp has earnings to profit at data conversion.
Thank you.
Okay, so let's do it again. The C Corp converts to S status. The C Corp has E&P at the data conversion. The S Corp sells most of its assets. And the remaining assets that were not sold create passive income. So when we talk about passive income, Emma, what do we generally mean by passive income? I mean, when we've talked about it in the past.
Like rentals.
Rental. There were two rules, really. Rental and what?
Portfolio.
Not portfolio. How many hours?
500.
500. Those are the two rules I wanted you to remember. Rental activity is always passive. Don't write it down. Or you can write it down and say, not in this case. Okay? Rental activity and 500 hours. This is a different terminology. Even though the words are the same, passive income, it's not the same concept. Passive income in this concept, and I'll say not 500, or regular understanding of passive, okay? Because 500 hours, it's not 500 hours. It's not in that same vein. However, rental, passive, and I should look this up. Passive in this context is rental. So that's consistent across both definitions. The second is portfolio income. Okay, if these exist, you got a passive income problem. And we'll demonstrate why the problem exists. So what passive income says, you had Exco. Oops. A owns Exco. Building and operations. Exco sells ops for $20 million. But the building is retained. and buyer rents building. This is not uncommon. This happens. So what passive income says is that once the operations leave the building, all you got is this building rental, you have passive income. And if you have passive income, you have to say, okay, was I previously a C Corp? Yeah, I was. Did I have E&P at data conversion, and do I still have it today? Yeah, I do. Did I sell all my assets? Yeah, I did. Is my remaining assets passive? Yeah, it is. So if all these things are true, then the passive income tax, it's more complicated, and the calculation is in here, and my give a shit level on going over the real calculation is 0. But from a 50,000 foot view, if my rental income is $100, 1, 2, 3, 100, 100, 100. And that's all that is left because I got the building. It says, we're not, you have E&P, you meet all these rules, we're going to inflict a corporate level tax rate in the same way I think built-in gains is on that number. So we're going to say it's 40%. 40, 40, 40. And the measurement, okay, so the measurement is, and I should have said this, which is an error. If 25% or more is passive income, then you have this problem. Since the building's the only thing that we have left, we have 100% of our income's passive. Don't care. If you have passive income problems, if you have an entity that meets this criteria and it has a building or it's had a portfolio, we need to talk. But what you do need to know is if you have the problem, it's subject to tax. And if you go for 3 years subject to the tax, you bust your S election. So the fix for this is if the corporation has C, E, and P of $10,000, just picking a number, which isn't very big, on a $20 million transaction, you can elect to say that the corporation made a dividend of $10,000 out of the corporation. You can strip 100% of the E&P out of the company and report a dividend to the shareholder because, again, the characteristic is C converts to S, C Corp has E&P. If the corporation strips the E&P and gives it a dividend out to the shareholders, well, it turns off this number 2. And if it turns off this number 2, then you can have all the passive income you want. So the solution is to strip the E&P. Now, Mark Duren has a client that he's been struggling with this for years. And he tries to find ways to make the income in XCO something more than 75% operational. And since he's been doing that, he's been holding at bay this calculation. So passive income says that if you have a C Corp, the converted S has CE&P, and it sells all of its assets and has passive assets left over, which are inclusive of rental and portfolio, then you have a problem. So why does this rule even exist? Or why do I think it exists? If you have a C Corp, I'm going to say XCO, A, E, and P is 5 million. Basis in the shares, I'm going to say is 0, effectively. XCO converts. We do our built-in gain calculation. That built-in gain calculation starts with tax basis, balance sheet, fair market value, inherent gain. So that's a piece that we have. We have E&P of $5 million. We don't sell anything. And at the end of the day, we make $1 million as an S Corp. We distribute $1 million as an S Corp in perpetuity. So my basis until I sell is going to remain at zero because basis floats up with the income and it's dragged back down by the distribution. So then we sell the entity an E&P of $5 million. So let's talk about what that means. That means that we have $5 million of, in the extreme, what E&P infers is we have AR of $5 million and equity of $5 million. Something is embedded in that corporation that has $5 million worth of tax basis. And whatever's embedded in that corporation of $5 million. So let's pretend for a second that Exco started with zero. Because I put zero in it. So that makes sense. So in year one, Exco does a contract with Lutz. Lutz pays Exco $5 million. I'm not going to worry about Exco paying tax because that's just going to muddy the water. They pay Exco $5 million or something more than $5 million. Exco pays the $5 million, which gives me, let's call it cash in perpetuity versus AR because that makes me feel better. Has $5 million cash because I want to distribute it. Has $5 million equity and has $5 million of E&P. We convert to S Corp. Now we make $1 million a year like clockwork. Basis goes up $1 million, basis goes down because we distribute. My E&P is the same as an S Corp. We get through the 5-year recognition period. And my balance sheet is still cash of $5 million, equity of $5 million. Because I don't want to pull it out. Because it's going to cost me a tax. So now, in year 20, we sell for $30 million. Okay? Cash-free, debt-free. So it's all going to be sale goodwill. I get to retain my cash. So now we have a $30 million gain. Proceeds is $30 million. Basis is zero, a $30 million gain. The K1 for how much goes out to A. Kaylee, how much K1? How much did my K1 say?
30.
30 million. So my basis on the outside, because every year I earn $1 million, I distribute $1 million. So my basis is still zero. So now I have a K1 of 30 million. So now I have 30 million of basis. But my cash, my equity, are now 35 million and 35 million. How I can distribute under normal S Corp rules $30 million and not have it be a return of basis. So now I'm going to distribute the cash, 30 million, zero, and that is now come out tax-free. I still have 5 million of cash and 5 million of equity. My basis is zero. If I distribute that 5 million of cash out of the company, I'm going to have a $5 million gain. I don't want to do that. So what I'm going to do is I'm going to put the $5 million, because all I want to do is invest it. So I'm going to buy $5 million into a portfolio that's going to kick off 10%. And absent these rules here, I'd be able to defer the $5 million in perpetuity. And $500,000 of portfolio income is going to kick off $500,000, so my basis goes up by 500, and it's going to go down by 500. Because I'm going to report the income because that's what's coming off the portfolio, and I can use those dollars to live off of it. So now I do this until I die. I'm dead. based on our earlier conversation, when I die, my asset, the S Corp stock, goes into an estate and it gets stepped up to fair value. And that asset that gets stepped up to fair value is $5 million. So now that S Corp goes to my child, their basis is $5 million. And guess what? Because I drug my feet and kept that portfolio inside that S Corp with CEMP, that never got taxed. So they're saying, look, we're going to put you on a clock. Either you can strip the EMP out of the company and avoid the problem, or you can bust your S election and we're going to subject it to double tax. And we're not going to let you get a step up when you die. Now, do I know that's what it is? No. But that's the best I can come up with to discern why this rule exists. Because again, for me, knowing the why the rule exists helps me to apply it when it occurs. Now, I did see this with Brad Stuthman. He had a balance sheet and he was selling it, and it was a prior C Corp, and there was a building, and that building was being retained, and even though Brad and Brett and some other people took this class last year, the passive income problem was blowing right past them because they weren't going to sell it. So this issue does exist. Mark has it. I just saw it with Brad, excuse me. And when I saw it with Brad, he didn't recognize it, but it exists. So again, what do we do there, Trent?
Diagnose.
The only way you diagnose is to understand what the fuck you're looking at. So I think that's all you really need to know about passive. I think. Hey, we don't care about the tax computation. Swear to God you don't. Okay, 1377 election. How much time we got?
42 minutes.
Was that an oh fuck? Is that what that was, Chambers?
Close.
Close?
Yeah.
Well, how close was it?
No. It was an oath.
I'm sure that's... Jameson, is that what you heard?
You dropped 2 knees.
You have to ask the microphone.
It's a bad spot for that.
That'll get edited out.
Yeah.
1377 election. We've covered this already on some level. All right, so stupid question. Have we covered this? Now I'm going to wake you up.
Yeah.
We have? Enough that we can leave?
Yeah.
Yeah?
Jameson can tell you.
Are you sure?
Are we gonna be able to get through the whole other book tomorrow?
I don't know. What's in the other book?
I don't know.
I don't know either. It'll be fun.
This is the split year election, right?
Yeah.
Yeah, we
Why
learned
don't you
this.
like it being called that? Like, what do you want to call it?
Termination of the tax year. That's what I call it. But split year's better. I'm good with it.
Okay.
So you're confident? You're the key to getting out of here.
Jameson.
We'll help you.
Yeah, could you torch
What
us about
time
the
do we get
1.1?
Do what? If you do it to my satisfaction and explain it, then we'll see.
Yeah, I don't know if we can.
Bring that to the council.
You can take it. I don't care. If you think you can explain this, Jameson, I'm tired of talking.
Speak in that mic too.
Just remember there's cameras, like 3 of them.
Oh, Jesus. This feels creepy. This feels actually creepy.
We got J and we got P. And then here we have J. Is this doing good so far?
Sure.
Can we read it first?
Wait a minute. What the actual... Really, you want to read it now? No, it's like, why don't I get that kind of support? Go ahead, let him read it.
Okay, I'll read it. Number 1, S Corporation allocates income to the shareholders on a per share per day basis. If S1 was owned 50-50 between Pete and Jeff and S1 earns 1 million, then Pete and Jeff both receive a K1 of 500,000. The other one's kind of cut off, but it says some facts except Ryan purchased Pete's 50% interest, something, something, something. Or is that where it's supposed to go to the green box?
Sure. You guys, I'm on a guided tour at this point.
Oh.
No,
Not
just
scary.
green box.
Huh?
So like it's covering words.
Yeah, move it.
Oh, real convenient.
Oh, we can't even read the question.
It was a trap.
Wait, do you have the PowerPoint version?
Pay attention.
I don't know. Maybe,
We're good.
you what? You shouldn't have done this.
Yeah, what's the setting for?
700.
500. Keep it consistent. Come on,
There's a
let's not
million.
get-
Okay, so if they have like $1 million of income, do I have this backwards?
Yeah. It should.
No.
No, because yeah, P leads. You got it
Yeah,
right.
so like it should go 500 to Pete, 500 to J.
Well, they'll each get 250 of
It's
the
a-
pill, and then the 500.
500 will all be.
Oh, I did.
But doesn't there have to be like a 20% change or something?
Uh,
Is that something else?
Oh, there you
yeah, under
20% of the house.
under 1.1368-1 section G election, there's some scenario.
30th interest.
It's really important.
What?
What did it say?
What do you do?
The only thing we were missing was June 20th.
Huge facts. Be able to solve it now. Jameson, can you write June 20th?
Should get all 500.
Yes.
So 750,
It's 30.
not 500, 500.
Okay.
Done.
Are you sure?
Wait, don't go. Wait, I don't know. Are we done?
I'm sure there's an answer in here somewhere.
Well, there has to be
Wait,
more than
where's the
20%
first-
redeemed.
This is the most lively you guys have been in like 4 hours.
We're brainstorming.
So this is what
There's- This is yeah the
happens if you
20%
don't
redeem.
take the 1377 election.
Just-
It's assumed that you just made it equally over the year.
You forgot it. Yeah.
So go ahead and do that.
But that's not fair because,
What do you mean it's not fair?
well, no, the tax on it.
Well,
Like someone's getting a windfall
So-
and someone's
She did it
getting
first.
screwed and someone's gonna be happy.
Okay. Did that help anybody?
Yeah.
Like,
Just
you
picking
guys
it
can
up.
say yes to anything. If you say,
Ryan, there's
Well,
Oh, I'm not.
that was the same. She was talking about what you
Oh, not
said
really
earlier
true.
today. With the whoever made partner buys in, and then there was, I think the example is earlier. It was like 900,000 over the year. They buy in after 300,000 had already been made, and then the new partners getting 300,000 where the other one had picked up 600 in
disproportionate
total.
amount of income.
Yeah.
So you're talking
And then-
about a second class stock issue.
Yeah.
Okay. What's that have to do with 1377 election? You're right, you're 100% right? I have no problem with what you're saying. But Jameson is quite convinced that she's gotten everything correct.
Well, I think the disconnect is she's doing something completely different than what's right here.
Oh, I'm not looking at this example.
Okay, so what's your example?
Just my own.
Perfect. Why don't you go over it
It's the
again?
same thing
We'll
with different
emphasize.
So
No, she's doing it.
this is January 1st.
Yeah.
This is June 30th, end of the year. J and P were 50-50
Okay.
right here, and then he sold his interest and is out of it, because J owns it.
Uh-huh.
So at the end of the year, say it was $1 million, maybe there should be 3 people, but it's okay. It would look like it should all go to J,
Mm-hmm.
but it needs to be split by, so like from 1 to 6, when the buyout happened, Jay should get half, he should get half,
Uh-huh.
and then after the buyout, Jay should get the remaining,
Uh-huh. Oh, that's right so far.
okay? And then
But Professor,
Yeah.
what happens if you make the split year election?
That is a split year.
Then you get this. You get,
Oh.
you wouldn't, a million wouldn't go to Jay.
It's not per share per day.
750 would.
Okay.
How did you?
What
split
happens if
your-
you make the split year election and it's not all earned
Equally.
equally over the year?
Then we ask Pete what to do.
Isn't it just math?
It doesn't
Yeah.
change.
It's
the same thing.
It's the same thing.
So why don't you say, well, let's play with it?
Let's
What-
play with it.
Let's do that.
Alright, so,
Let's say that the million was earned all the first half
okay.
and zero the next half.
Alright, so 500 and 500.
Okay.
He gets 500, Jay gets 500, Jay has 0 for this half.
Okay. What if you invert it?
If we have 0 and a million,
Yeah.
0 for J and P, or for P, 1 million for J.
Okay. I'm okay with all that. So what if you don't make the election at all?
If you don't make it, then Jay's getting a million, but he still has to pay some tax. Or is this one K1? The million with just one Jay's K1?
Okay. So let's stick with your.
It's just per share.
Let's invert it. Let's go from 0 at the beginning to a million on the other side. So if you do that, Jay is going to have $1 million. So why don't you just go ahead and erase that and give Jay the full million now that we're. See, there's an eraser right there, kid. Yeah, that. Okay, because you made the election.
Wait, yeah.
If you didn't make the election, how's the income allocated? If you don't make the election?
If you don't make the election, he's the only owner. And so he gets the full million.
No, it's a per share per day.
Yeah.
Making the election says you got to measure the ownership in the period, the first period, against the income. The ownership in the first period was 50-50. The earnings was 0.
Oh, so they need to get 500,000. No.
It's like we got JD tax threats up here from yesterday.
But you have to do some math.
Yeah, you got to do some
Well-
math.
One stay the whole time.
You see the whole time? How do you guys feel about
No,
that?
no way.
You got it.
Let's
Why
work
do you
through it.
ruin everything?
You can tell if they get their ass up here.
Jimmy, get your
No.
Oh, really? So it's okay to throw Jameson under
Yeah.
the bus.
My ass is comfy back here.
So, but we want her to take the bullet for everybody to get out of here? Is that what we're getting?
Yes.
What does she
No.
get out of it?
She can get her $0
have a
gift
gift
card.
Oh, is that what she gets?
Yeah.
Okay, so if we don't make the elections per share per day,
What do you
Wouldn't
get? 25.
Just be 250, 250, 500. And then Jay has 750. He has 250. No.
No.
You looking near her.
Her.
Oh.
Wouldn't they each split the million?
no.
No, because that'd be as if they were
Like,
both
we know it's
full year.
500 before and after.
Whole time.
Oh, this is fabulous. I can't wait to see where this is going. Go ahead.
Wait, I think we're overcomplicating
Yeah.
this.
Yeah.
The first half is 500K, the second half is 500.
No, that's the split. That's making the election.
I was making the
Oh.
No.
Oh, wait.
Fuck, why don't you listen to Tatum? She's on it.
I don't think so.
You don't.
First. Oh, do you think?
Isn't
What do you
250,
think?
250 and 500, right?
Now I'm getting confused.
If you just
Well,
add
which-
$1 million
which-
and then so half of it.
Oh my god.
Like, when they don't make the election, you don't need to treat the two periods separately. So, I think,
Yeah.
like,
Draw,
that's
erase
where
the
it needs
middle
to
line.
separate. Yeah.
We
Well,
need
that
to
cleared it up for me.
Well, I just think it helps.
Because
Alright,
they have
so
to allocate per share.
500. Well, no, because
500 for half the time.
But then we have
Yeah,
to
but
figure
per share
out
per day is it
what
just half and half?
P's ownership percentage is for the year.
Alright, so he's a 50% owner until 6/30.
Okay.
And then he's 0. So do we take the average?
Go average.
He's a 50% owner for half the year, so he gets a quarter of the total income.
Yes.
Yes.
I thought we did this.
I personally think Tatum was right the first time.
That's what I was saying.
I think it's 250, and then 5.
Okay, so 250.
Yeah, we do that on
I think
returns
we do
weekly.
stop
Yeah.
and
As ownership
clarify.
changes, isn't that what that is?
How we were taught how to do it.
Isn't that what
I
we're
think
doing?
it's, I think we're saying the same thing though.
I don't do that.
Oh, hell no.
Access does this for us.
Yeah.
Because
Yeah, because they earn half, because then
Yes.
the person was 7,000,
It's
and
just
then they are
not
50,
making the
50
math
owners,
as complicated
250,
if we keep
The tax software does it for us.
Access does this for us.
Does.
Just pull it up.
I think it would be he gets 250 total.
Yes.
Jay
Yes.
gets 750.
Yes.
Is that right, Michelle?
I don't know.
Isn't that the same that they got when they did the election?
That's right.
Oh,
Good job,
I'm,
Tatum.
I'm curious at what we're even asking.
Or is that what they each split? Well, I guess.
Now it's more.
Well, what's funny is
50,
you haven't even gotten to the point yet.
Oh.
No, this is good. I mean, the calc's right.
yeah, don't write in.
Okay, so this is if they do not make the election.
Yes.
And if they did, it would be J 1 million.
And P0, correct.
Yeah.
Yes.
So, anyone know the next part?
We go home.
Trent.
Is there
You
more?
be.
They get
Is that not
K1.
I mean, like, all I know is you got to make 2 separate book to tax schedules because you're going to have different M1s at different points in time. So you need financials from 2 different sets of periods. It's like, that's where the big difference is going.
I agree with all this so far.
What were we getting into here? What else?
I don't know what else he
What's the
wants me to say.
You want something with like the tax pay?
Wait, last time we multiplied the 1.2 million
This,
times.
we're beyond
Question is
that. I'll give
keep
you
going.
that.
Do you want the election?
Oh,
I
what?
do.
Because for S corps you have to make an election, but for partnerships you don't, correct? Or is that backwards?
Well, both you have to, there's an election outside the system for partnerships. There's an election inside the system, meaning it has to go with a return for S corps. That's true.
It has to be signed by the shareholders and attached to the return
Why?
because all parties have to agree. All involved parties have to agree on it.
Why?
So
Because the income allocation is gonna have an impact.
Yeah.
So if Jeff or Jay or whoever is not amenable because they're gonna pick up $1 million of income, why would they sign that? Why would they agree to this income allocation?
With the new one?
Why would they agree to a cutoff? Jay's a hell of a lot better reporting 750 of income. Because Jay's the one sticking around.
But it's not fair to Pete.
Well, we're on bad terms. I don't give a shit what P thinks. So I'm not agreeing because we're mad at each other already. So why am I going to take 250 of your income and agree to this election?
So then how this gets solved if they both wouldn't disagree?
The rule is it's a per share per day basis unless every shareholder agrees. It's a per share per day basis. So what's my 1368 1.1368-1G say? I can't remember.
There's 2 scenarios.
I mean, I can't remember what one's 20%, one's 25%.
Sailor redemption
There's 20,
25%.
20%.
Which one's 25%?
Sailor redemption of 20% of the outstanding shares.
Corporation
Oh, sale or redemption, and then is the contributions 20%? Is that what it is?
corporation issues 25% or more based on the previous issued share.
Jesus.
That's what your book
That's
says.
what
I know. What's it say? Let me see.
You calling me a liar?
No, I probably fucked it up. Sale or redemption of 20%. I thought you said 25%.
No.
Okay, I misheard you. Corporation issues 25%.
Yeah.
Okay. So that same opportunity exists if the corporation issues 25%, or whatever those numbers were. I can never remember which is which. All right, so how much time do we have left?
That was electric.
See, that's what you could say.
Really?
Like that woke me up.
Yeah, me too.
That
Woke me
Me too.
that was a little bit of mayhem. And watching everybody try to cipher through it so you can get out of here early. I mean, I don't.
That's how you learn.
I waffle in between. Oh, we want to go to Florida. We want you to go with you. Oh, that's so sweet. To let me the fuck out of here.
No,
I don't know which way this is going.
I just needed to wake me up.
Us struggling through that. We learn.
Actually, Chambers, I didn't want to call you out, but you were almost on the floor asleep. I saw you back there. You were slumped over. I'm like, God, is he having a heart attack? I'm sure he's okay.
Yeah.
Well, you should have seen Jimmy. That's why I was getting sleepy.
No.
Jimmy was doing this. Like,
Were you?
yeah.
Were you, Nicola?
I have video.
No, we're not.
Let's see it.
No one's showing the.
Hey,
Wait.
shoot it to my sister.
Do you actually have it?
Fine.
100%.
Wait,
That was just embarrassing.
What was?
yeah, fine.
That, I
Why?
think you did great.
Alright.
It was a
Enjoying it.
I sent it to you. Did you?
You're the
Yeah.
only reason I might actually let you out of here early. Because I'm a big liar. I wasn't going to let you out at all. On. So Q subs.
Show a feet. If you see it.
Hold on, I'm seeing what we're going to do tomorrow. I'm trying to
It's
make a
not that
decision.
bad.
I almost deleted that and took the one right after because that's when we started the fall.
Sam, do you think I can make it through this tomorrow?
I don't know, but I want you to.
Sam, do you think I can do it?
Say yes. Because my answer is gonna depend on what you.
Yes.
How do you know? Look, hey, you're the one that always wants to call breaks.
Great.
Huh?
Hey, that's fear.
I believe in us.
No,
No.
I don't believe
I
a
start
word
hearing
of that.
whispering back here.
I don't believe a word of that. Not
I
a
think we
word.
should flip rows tomorrow.
No.
Oh, what?
Why?
Yeah, we're gonna do that.
Yeah, let's switch things up a little bit.
All right, I think I can get.
I think we should teach.
I think that too.
He should listen.
So everybody needs to thank who?
James.
Jameson.